Well, stock futures set to pull back from record highs after this morning's jobless claims in the Philly Fed survey, adding to a string of some of that weakening econ data. And some market participants out on Wall Street are warning that the recent rally that we have seen, those record highs for the S&P, could actually be due for a pause. Let's talk about what's next. And for that, we want to bring in Victoria Fernandez, Chief Market Strategist at Crossmark Global Investments. Victoria, it's great to have you back here on Yahoo Finance. So talk to me about where you see the market headed. How big of a risk are we at here for some of this momentum to come to a halt?
Yeah, Seana, I think it makes a lot of sense that as we look at the expectations we have in this marketplace, look at earnings. I mean, you're just talking about Walmart earnings. People are expecting another full year of double-digit earnings growth. That's been very supportive of this market and the bull run that we have seen so far. But I do think when we look at the bifurcations that we're seeing, whether it's sectors within the S&P, whether it's triple Qs versus Bitcoin, whether it's S&P and NASDAQ, and how we're seeing relative highs hitting here versus not in the advanced decline line. Lots of bifurcation going on that we've talked about in the consumer, but we're seeing it really flow through to this market. So we wouldn't be surprised to see a 5 to 10% pullback. That doesn't put us into recession, but it does help the market come back and consolidate a little bit around some of these very lofty expectations that are out there. Although earnings have continued to do pretty well, we need to see them hold up in the next few quarters in order to sustain the valuations that we're seeing. And I think that might be a tough call to make.
Which sectors are best positioned from your analysis, even amid some of the bifurcation that's expected?
Yeah, so Brad, I mean, look, we like financials. We've talked about it many times. It's been our favorite sector for a while. And when you look at trend lines, when you look at momentum within the sectors, financials continues to do well. And it's actually had a little bit of a pullback, a little bit of consolidation, but still in an uptrend. So we like financials and think you can continue to add here. You've had a little bit of momentum in healthcare as well. We know that sector has been hit really hard, but perhaps you're starting to see an area where you could tiptoe in to that sector and add. But you're looking at parts of industrials, you're looking at staples, you're looking at utilities. These are really the bifurcated sectors where you have to go in and really do your homework on the fundamentals of the names that are in there and not just do a sector across the board. It really bodes well for active management. It really bodes well for long-short portfolios for our clients.
So Victoria, I guess overall then, do you think that the resilience that we have seen in the market, is that justified?
I think it's justified to an extent, and there's probably a little bit more room to go here. We know 70% of our economy is driven by the consumer, and the consumer continues to spend. We've seen that in the consumption numbers. But Seana, look, we saw numbers go up on consumption, but we saw savings numbers come down pretty significantly. We're seeing composite PMIs that are equivalent or correlate to about 1.5 to 2% GDP growth. That's slower than where we are now. So is there a little bit more room to run here? Yes, because earnings are still supportive. But are we seeing things telling us the economy is going to slow down? Yes, we are seeing that as well. So I think you do have to be cautious in where you put your money to work.
Do you think that that will mean sweeping earnings revisions, or will it be selective? What are some of the pillars that you would be looking out for there, especially as we're getting through some of the retail portions and the most consumer sensitive portions of this earnings season?
Right. I mean, you take Walmart as an example, since we saw those earnings today. I mean, that was the shining star for retail last quarter. And now they're even giving pretty conservative guidance for 2026 and talking about even some of the high income consumers starting to spend down and pay less. So I think when you're looking at earnings, I don't think we'll see a sweeping movement across. There's going to be sectors that continue to do well and have support. We talked about financials continuing to do well and other areas starting to come back a little bit. But obviously, you look at Mag 7 names, you look at some of the valuations that we're seeing there, those are starting to pull back. And we have to wonder if the earnings we've been seeing this quarter, Brad, are pulled ahead because of tariffs and other elements that people anticipate over the coming quarters. So I think you'll have selective areas where you see earnings revisions start to come into play, but it should rotate through all of them over the next 12 months.
Victoria, what's your reading on inflation and how big of a threat maybe this could be overall, obviously, to the economy, and then the trickle-down effect here just in terms of how the market should be looking at that risk?
Yeah, it's really interesting because if we look at the move in the 10-year treasury, a lot of people assumed that was just inflation concerns driving it higher and then seeing it come lower too, having some of that back off. But it mostly was term premium. It wasn't really inflation that was concerning people. We've just started to see 5-year break evens move higher. So that's just starting to come back into the conversation. Is it tariffs that's driving that? I really don't think so. I mean, you can tell over the past couple weeks, the market and investors are really kind of saying, we're not sure tariffs are going to be something permanent. It's probably a temporary move, and we could see some volatility in expectations, at least in short term inflation expectations. But I think longer term, those are still pretty well anchored. And even though it's sticky because of housing components, because we've had wages move higher and new labor deals that will continue to see wages over the next couple of years, you will have those sticky components. But I'm not sure we're going to see the huge swings in inflation that some people are anticipating.
Victoria, thanks so much for taking the time here pre-market.